right, let's get a closer read on equity markets, and we might also touch on crypto in just a moment too. To do that, we're joined by Shawn Hickman, research lead at Market Matters. Shawn, good to see you again.
Nice to be back.
All right, now, what have you observed on the market in the last couple of days? Because it was all dependent on what Jerome Powell had to say on Friday, because we saw that sharp sell-off on global equity markets. It was a pretty savage day on the local market yesterday. What's your assessment?
We thought he'd be quite hawkish. I didn't think he'd be that hawkish. 1,000 points in the day tells you that the market didn't think we'd see that either. But you can't ignore that. That's not going to go away in a hurry. He's now saying, sure, rates are going higher, but they're not coming down very quickly next year either. And I think the market was looking for higher rates, but they were also hoping that rates would come down next year. I think they're wrong on that front. These guys are going to spend a lot of time to put the inflation genie back in the bubble, and they're not going to risk it popping out again in a hurry.
So was that something of a reality check then? Perhaps markets had got ahead of themselves just as far as pricing in the potential for rate cuts next year. But as we heard from Powell and other Fed members, they're saying it's going to go higher, it's going to stay there for the foreseeable future. And therefore you saw, I guess, that risk-off, that savage risk-off reaction. But also, I guess, given where markets have been from those June lows.
I think so. I mean, at the end of the day, it's common sense. They've been hit with this inflation explosion. You know, if you fight hard to put it back in the bubble, why would you then risk it coming out again? So they've just made some common sense comments. I think, as I said last time to you, we think bond yields go higher before they come back. And it's just the Fed trying to keep things in check, trying to calm the markets down and say, look, we're not just going to give you a free pass again. We're just going to make you be realistic. And that's what they did.
How are you seeing the local market then? Of course, we have earnings results out here. What are investors looking at the moment? Obviously, you've got one eye on what's going on in the States and how that's affecting the global economy, but also earnings and, in particular, guidance.
I think earnings are good. Earnings have definitely been on the good side. I think we've got over 60% of beats. Guidance is okay. People are a bit nervous around guidance, which makes sense again. But I think things are good. Investors are in a few different camps. You've got investors that are scared. They see 1,000 points drop in the Dow and they're thinking, I don't want to be in shares. But at the end of the day, we think this is a market to buy into pullbacks. As I said to you last week, bond yields will edge higher. They have. Equities will edge lower. They have. We think you should be buying into weakness. We haven't quite started doing that yet, but we're watching very, very closely for the right time to do so.
All right, let's talk stocks specific then. And I know you've taken a look at Seek. Interesting, after it released its report, shares tumbled. But you would think, given the tightness of the jobs market, that Seek is looking good at the moment.
Definitely, and we touched on Seek last week. That's why I thought I'd look at it again this week. It's like a part two. So last week I said to you, maybe around $20 Seek would be worth looking at. After the Fed comments, after what they're saying, how hawkish they are, we think Seek can now go under $19, but the company's looking good. And I think this is a stock again to be buying on the back foot. Be a little bit fussy, be a little bit patient, but it looks good.
All right, yeah, because we just got the chart up on the screen there, and the 1 year, as you can see, it has come off. What it was back in November, it was $35. Now back, as you say, close to 20. So you're seeing that as a buying opportunity.
Slowly but surely, yes. And it's not the only. Let's be realistic as well. It's not the only tech stock looking like that. If you look at Xero, there's some other big names that have done exactly the same thing.
Yep.
As we've had the PE contraction come through the whole market.
All right, let's switch to financials and the big banks, and in particular NAB. What are you seeing there?
NAB's our favourite bank at the moment. Well, we own, I'll rephrase that, we own Commonwealth Bank, we own Macquarie Bank. NAB is the bank we want to buy on the back foot. And I think a few more percent in NAB, we'd start to accumulate that stock as well. The reason I thought we'd have a look at NAB is because obviously most people, most retail investors in particular, look at the banks very closely. It's not going to be that long until the November dividends are coming up. And seasonally, it's a good time to buy these stocks around that October, November. And if they're coming down to that time frame, it's a good time to add a bit to your portfolio, assuming you're in cash, of course.
Okay, into retail, in fact, Super Retail Group. How do you see that at the moment?
Probably our preferred name in the sector. Again, consumer spending is good. Retail spending yesterday was fantastic. It blew the lights out across the board. Anywhere around that $10 mark, we think Super Retail is a great buy.
What are you seeing with the company going forward? I mean, would you call this discretionary or not?
I think so. I think it is to a certain degree. I mean, sure, it's not like it's jewelry, but I think it is discretionary spending. And it is spending per se, isn't it? It's no different to when you're going to Woolworths. People are going to buy food. Are they going to buy the expensive cheese or the cheap cheese?
Yeah.
They're still spending money.
Yep.
So I would call it discretionary spending, yes.
When you break it down into sectors, which ones do you prefer to be investing at the moment, and perhaps the ones you're avoiding? I was looking at this note from Goldman Sachs saying now is the time to buy commodities. Would you agree with that? They're saying the prospect of recession is not great outside of Europe. In other words, yes, likely to get recession in Europe, but elsewhere, demand is likely to be resilient.
I think they might be a little bit behind the curve. I also read that article. We've been long commodities for a long time, and as I said to you last week, we're still long commodities, and I'd stay long commodities. Is this the time to wade into the sectors? I don't think so. I think it's the time to watch your positions carefully. Last time we got interest rates are going up, we got concerns about inflation. We saw that on Friday in a big way. Yesterday, the resources stocks held up very well. I mean, BHP was hardly down, and I think that will carry on for a while. But then the next chapter in the book will be, okay, they're pushing up rates. Will that see a recession? How deep will the recession be? And at the moment, I think the market is discounting that, and that's the risk to the commodity markets, is what's being priced in. So do I like them? Yes. Are we long them? Are we overweight the sector? Yes. Yep. But I think it's quite late in the cycle to be saying go out and buy them.
More specifically, energy. How are you playing that at the moment?
We're long Woodside.
Yep.
We've been long Woodside for a while.
Have you had a chance to have a look at the result today?
I haven't, no. I've been in reception waiting for you.
Right, okay. When you get off, you can take a look at that to see whether you're going to double down on Woodside then.
Hopefully I'm not going to panic.
All right. Shawn, just before you go, we started out there taking a look at the crypto markets. Interested to get your perspective of how that's travelling at the moment, and interesting that also that Bitcoin managed to pull back above 20,000, which is quite critical for that coin. A lot of people would say, what is the use of crypto? Well, there's one use, I guess, in that when equity markets are off on the weekend, that the crypto keeps going, of course, which is a good indicator as to perhaps how to treat risk assets at this point.
Cryptos are a great leading indicator. On Bitcoin in particular, it shows liquidity, it shows spare cash, that investors, traders, punters have got to play in the market. And my feeling is, we've said for a long, long time, avoid crypto, and we've missed a huge drop in it, so I'm feeling great about that. But the next sell-off in crypto, if we see new lows, and it's a big if, but if we see new lows, I think from a risk-reward perspective, you actually could buy it. It's the first time you've probably heard Shawn Hickman say that in years.
Right, okay. What, specifically Bitcoin, or you need to spread your risk there?
I would probably just go with Bitcoin, because it's not something we follow very closely.
Yep.
So I would keep it simple, stupid. Go with Bitcoin, buy if we see new lows. From a risk point of view, don't give it a lot of room. But that's probably tying in with how we see the market as well, which is buy the next level of weakness if it unfolds.